Mania on Wall Street has been, of the past few years, spawned a boom in the so-called junk bonds, those high-yielding debt issues that many companies use to finance acquisitions of other companies. Ted Turner's failed attempt to acquire CBS, by the way, was to have been financed by junk bonds, for example. A junk bond, well, that's generally considered to be a bond rated BB plus or lower by Standard & Poor's, or Ba1 or less by Moody's Investor Service. And now with the insider trading scandal growing, many investors question just how safe those junk bonds are. Fortune magazine recently released the results of a study conducted for it of the junk bond market industry. The man who conducted that study is with us today. He's Mr. Marko from the consulting firm of Houlihan, Lokey, Howard & Zucken, based in Los Angeles. You also have offices elsewhere. You do a study of the solvency of companies, and you did one
Correct.
This massive study of the entire junk bond industry.
That's right.
The basic result was the market will not collapse, but it could be rocked to its foundations, according to that Fortune magazine article. How bad is it right now, in your opinion?
Well, right now, let me set the record straight on that. We view the junk bond market as it's bigger, stronger, healthier than it's ever been.
Okay.
However, and that's partly caused by the fact that other firms are coming in to the area very strongly. However, what we've done with Fortune is to look at objectively, systematically, all the companies that make up this so-called junk bond market.
You studied a universe of 500 companies that have issued junk bonds, face value by what, $72.5 billion.
Correct.
Of those, about 5.5% are what you consider to be vulnerable right now to default.
Exactly. About 5.5% are what we would call vulnerable. We called them atomics and subatomics. These would be the bonds or the issuers of the companies who have the greatest probability of defaulting in the next several years. However, we would not be predicting that all of them would default. And also, it's important to note that our study did find as well that most of the companies that make up the junk bond market are not vulnerable to default, and actually the credit quality is not that bad overall.
Put that in perspective, the average default percentage of those companies on an annual basis is about 1.5% right now, isn't it?
Correct.
So 5.5% is rather high.
Correct. 5% is high relative to the 1.5%, and as a matter of fact, we may see higher numbers in the future if we should happen to have something on the order of a recession which would teeter some of the weaker companies. Okay,
if somebody's interested in potentially getting into those junk bonds, because they do have a rather high yield, although they are unsafe in many cases, what do they look for? How do they determine for themselves if it's a good investment for them? Okay,
there are a couple of important things that an investor should be looking at. A couple of lessons are this. One is, don't be seduced by extremely high yields. There are a lot of companies out there which yield more than, say, 14–15%.
Right.
What we found is the market prices these bonds very, very well, and that you don't get 14–15% if you're not going to take on a great deal of risk.
The higher the yield, the higher the risk.
Exactly. No free lunches are out there.
Right.
That's one of the stories. Secondly, looking at a Standard & Poor's or a Moody's rating just isn't enough.
Okay.
It's an important piece of information, but it doesn't tell the whole story. From our standpoint, we like to look at, and we would advise people to look at, companies that have large market capitalizations on the order of 500 million, a billion or more, and there are some in the junk category which meet that criteria. We call them high quality or investment grade junk, and they were listed in the article.
Okay, so anything but above generally 14–50%, that's the critical point to watch for, huh?
Well, that is a point by which companies generally become extremely vulnerable past that point. There are vulnerable companies below the 14% range, however.
Thank you for joining us today.
Thank you, Bill.